Every single payday, the same thing happens. The money arrives, and then, before you touch a cent of it, a chunk disappears. You didn't spend it, you didn't invest it, it was simply taken. And the frustrating part, the part that quietly burns, is knowing that somewhere out there, people earning far more than you are keeping far more of what they make. That's not a conspiracy theory. It's written into the tax code. And today, you're going to understand exactly why. Let's start with a number. In the United States, the top marginal income tax rate on wages is currently 37%. In the UK, it's 45% for earnings above £125,140. In Australia, the top rate hits 45% too, plus a 2% Medicare levy. Canada's combined federal and provincial top rate can exceed 50% in provinces like Ontario. If you're a high-earning salaried worker, the government is your largest creditor, by design. Now here's the part that doesn't make the news. Warren Buffett famously pointed out that he pays a lower effective tax rate than his secretary. He wasn't ashamed of it, he was drawing attention to something structural. The system wasn't built for workers, it was built for capital. And understanding that difference is the first step to using it.
There are, broadly speaking, two types of income in a modern tax system. Earned income, what you get from a job, a salary, a wage, and unearned income, what you get from assets, dividends, capital gains, rental income, interest from certain vehicles. The tax treatment of these two categories is not equal. In the US, long-term capital gains are taxed at 0%, 15%, or 20% depending on your income, not 37%. In the UK, capital gains rates top out at 24% for property, compared to 45% on income. In Australia, assets held for more than 12 months receive a 50% capital gains tax discount. In Canada, only 50% of capital gains are included in taxable income at all. This is not a loophole. This is the architecture. It was designed this way. Policymakers over decades argued, and many still argue, that taxing capital gains at lower rates encourages investment, risk-taking, and economic growth. Whether you agree with that logic or not is beside the point right now. The point is, the rules exist, they are legal, and they apply equally to anyone who chooses to play by them. So why don't more people know this? Partly because the financial education system never taught it. Partly because understanding it requires moving your thinking from income to assets. And that shift is harder than it's.
Economist Thomas Piketty spent years studying wealth inequality across 20 countries. His landmark 2013 work found that returns on capital have historically outpaced economic growth, meaning the people who own assets consistently outpace the people who sell their time. That gap doesn't close on its own. It widens. And the tax code, as currently structured in every major Tier 1 economy, accelerates it. Here's the core mechanism. When you earn a salary, every dollar is taxed at your marginal rate before it reaches you. When a wealthy investor earns a return on capital, a dividend from a share portfolio, a gain on a property sale, a distribution from a business, that income is often taxed at a lower rate, sometimes deferred, sometimes partially sheltered, and sometimes passed down in ways that reset the tax clock entirely. Three structures matter most, and every one of them is available to you, not just to the wealthy.
The first is tax-advantaged accounts. In the US, the Roth IRA allows after-tax contributions to grow and be withdrawn completely tax-free. The 401k and traditional IRA allow pre-tax contributions, reducing your taxable income today. In the UK, the ISA, Individual Savings Account, shelters up to £20,000 per year in investments that grow and pay out entirely tax-free. In Australia, superannuation contributions are taxed at just 15%, well below the income tax rate for most workers. In Canada, the TFSA, Tax-Free Savings Account, functions similarly to the Roth IRA, sheltering all growth from tax permanently. These aren't secrets, they're just underused. A 2022 study by Vanguard found that over 30% of eligible Americans contribute nothing to any tax-advantaged retirement account in any given year. The wealthy don't leave these vehicles empty. They fill them first. The second structure is capital gains positioning. This is where the real divergence happens. A salaried worker converts their time into income and pays income tax on it. A wealth builder converts income into assets, index funds, real estate, businesses, and eventually converts those assets back into income taxed at capital gains rates. The longer the assets are held, the lower the effective rate. In the US, hold an asset for more than 1 year and the preferential long-term rate kicks in. In Australia, hold for more than 12 months and you cut your CGT bill in half. This is why investors think in years and decades, not months. Not because they're patient by nature, because the system rewards patience with a lower tax bill.
Now, pause for a moment. If you're watching this thinking, this sounds great in theory, but I don't have enough left after bills to invest, that reaction is completely valid. And it points to the real reason most people never close this gap. It's not knowledge, it's cash flow. The structural tax advantage of capital means nothing if you never accumulate capital in the first place. This is the pattern interrupt the financial media almost never addresses. The tax code doesn't just favor the wealthy because they have better accountants, it favors them because they already have assets. The first job is to get some. And you do that by treating your tax-advantaged accounts as non-negotiable before anything else. If you're finding this valuable, now's a great time to like this video and share it with someone who needs to hear it. And if you haven't already, subscribe to After Tax Academy and turn on the notification bell. New episodes go up regularly, and every one of them is built to help you keep more of what you earn. The third structure is business ownership and pass-through income. This is where the gap between salaried workers and wealthy investors becomes a chasm. A business owner in the US operating as an S corporation or LLC has access to deductions that a salaried employee simply does not. Home office, vehicle use, professional development, equipment, health insurance premiums, travel with a legitimate business purpose. These deductions reduce taxable income before it's taxed, meaning the effective rate drops considerably. In the UK, self-employed individuals and limited company directors have access to similar structures, paying themselves partly in salary, below the national insurance threshold, and partly in dividends, taxed at the lower dividend. In Australia, structures like family trusts and company distributions have historically been used by business owners to split income and reduce the overall tax burden. These aren't tricks, they are choices that the tax code makes available to anyone who chooses a different economic structure. Now, researcher Daryl Collins, co-author of Portfolios of the Poor, found something striking when studying financial behavior across income levels globally. The structural difference between those who accumulate wealth and those who don't is rarely intelligence or effort. It's almost always about which financial instruments they're connected to and which they're excluded from, either by design or by ignorance. The wealthy are connected to structures that convert income into capital and tax capital less. The middle class, overwhelmingly, is not. This brings up the honest part of this conversation. Not everyone can immediately restructure their finances into an S corp or a family trust. Not everyone has the income surplus to max out a TFSA and an ISA in the same year. The after-tax advantage isn't a light switch, it's a direction. And you start moving in it by doing the smallest available version of what the wealthy do. Open the ISA, open the Roth. Put something, even something small, in your superannuation beyond the compulsory contribution. Buy the first unit of an index fund inside a tax-sheltered account rather than outside one. Choose assets over spending when the choice is genuinely available. These aren't massive steps, but they're steps in the direction of capital. And once you're moving toward capital, the tax code starts working with you instead of against you. Here is where the real twist lives. And it's the part almost nobody in mainstream financial media will say directly. The tax code was not designed to be neutral. It was shaped over decades by people who already had capital and who had strong reasons to protect the after-tax returns on that capital. You can be angry about that. Or you can decide to understand it deeply enough to move your financial life into the structures it favors. Both reactions make sense. Only one of them changes your outcome. Economist Emmanuel Saez at UC Berkeley has published extensive research showing that in the US, the effective tax rate paid by the top 400 wealthiest individuals is lower than the rate paid by the bottom half of wage earners when all taxes are accounted for. The same pattern appears across the UK, Australia, and Canada in various forms. Saez doesn't present this as evidence of individual wrongdoing. He presents it as evidence of structural design, a design that responds to structural choices, including yours. At the 40% mark of this video, you now understand the three structures: tax-advantaged accounts, capital gains positioning, and business income structures. What you do with that knowledge is entirely up to you. But here's the thing, the gap doesn't close by itself. Every year you leave a Roth IRA unfunded, you're leaving a legal tax shelter empty while paying full marginal rates on the same income. Every year you hold growth assets inside a taxable brokerage account when a sheltered one was available, you're gifting the government a larger share than you have to. The legal reason wealthy investors pay less tax than salaried workers is simply this. They earn income from capital, they hold it in sheltered structures, and they convert it back to spending at preferential rates. The system rewards this. It was built to reward this. And it rewards you for doing exactly the same thing as soon as you start. You opened this video because something about the title felt true. Because some part of you already suspected that the difference between the wealthy and everyone else wasn't just hard work or luck, it was structure. And now you know what the structure looks like. The next step isn't complicated, it's just a decision. Open the account, make the contribution, buy the asset. Not because the system is fair, it isn't, but because understanding how the system actually works is the only way to stop letting it work against you. Tonight, when you open your payslip and see that number disappear, you'll know exactly where it's going. And more importantly, you'll know exactly what you can do about it.